Welcome to The Explainer. Today we're going to talk about a tool that traders have been using for centuries to get a read on the market, Japanese candlesticks. Now, these aren't just random bars on a chart. Oh no. They're a visual story of human emotion, of fear, of greed, of indecision, all packed into one simple shape.
I mean, really think about that. What if you could just glance at a price chart and instantly get a feel for the entire battle that happened? The fierce struggle between buyers and sellers, those moments of doubt, the big victories. Well, that's exactly the power of the language we're about to dive into.
You know, every language, whether it's English or Python, has its own alphabet. And the language of price is no different. So to read the market story, we first have to get a handle on the 4 key letters that make up every single candlestick.
And here they are. It's kind of wild to think that every single one of these candlesticks, whether it represents a minute, a day, or a week, is built from just 4 pieces of data: the open, the high, the low, and the close. That's it. These 4 points are the bedrock of everything else we're going to talk about.
Okay, so we've got our 4 numbers. But how do we get from that simple list to the iconic shape of a candlestick that we all recognize? Well, let's break down the anatomy and see how this data really comes to life.
All right, first up is the real body. That's the thick, rectangular part right in the middle. This is the main event, you know? It shows the real tug-of-war between where the price opened and where it closed. The size of this body tells you just how much ground was won or lost in that battle.
And then, sticking out from the body, you have the shadows, or as some people call them, the wicks. Think of these thin lines as the extreme points of the battle. They show the absolute highest and lowest prices that were reached during that session. They really reveal the full extent of the market's ambition and its fear.
So, how do we know who actually won? It's simple. The color tells the story. If the body is green, or sometimes white, it means the closing price was higher than the opening price. That's a win for the buyers, the bulls, who charged the price up. But if you see a red or black body, that means the sellers, the bears, dragged the price down and it closed lower than where it started.
But look, knowing who won is really just the beginning. The real insight, the juicy stuff, comes from understanding how they won. And the size of that candlestick's body, it's a huge clue that tells us about the conviction and the momentum behind the move.
Just look at the difference here. A long, solid body, doesn't matter if it's green or red, that signals a knockout punch. One side was clearly, decisively in control. But a short little stubby body, that tells a totally different story. It's a tense standoff, a moment of indecision where neither the bulls nor the bears could really gain the upper hand.
Okay, so we've mastered the letters and the words. Now it's time to start reading sentences. And this is where it gets really, really interesting, because individual candlesticks start to group together to form patterns that can give us hints about what the market might do next.
Let's just stick with this language metaphor for a second. If a single candle is a letter, then a pattern of 2 or 3 candles is like a word, or maybe even a short sentence. These patterns give us crucial context, and they often signal a potential change in direction or confirm that the current trend is still going strong.
Now, these patterns are usually grouped by how many candles they use. Some patterns, like the famous doji, tell a whole story with just 1 candle, signaling a moment of perfect balance and total indecision. Then you've got 2-bar patterns, like a bullish engulfing, where a big green candle just completely swallows the previous red one. That suggests a really powerful shift in control. This just gives you a taste of the rich vocabulary that traders use to read what's happening.
Okay, but hold on. Before you run off and start seeing patterns everywhere, there is an absolutely crucial piece of wisdom we need to cover. Honestly, this might be the single most important lesson when it comes to using candlesticks.
So let's ask the question directly. Let's say you spot a perfect, textbook, bullish engulfing pattern. Is it a 100% guarantee that the price is about to shoot to the moon? This is a really dangerous assumption, and it trips up a ton of new traders.
And the answer is a clear, resounding no. A pattern is just a hint. It is not a prophecy. The best traders know this. They use these patterns as clues, and then they look for other things like trading volume or the overall trend to confirm what they're seeing. The pattern is just one piece of the puzzle.
So if you remember one thing from all of this, let it be this. Candlesticks give you clues, not certainties. They are an incredible tool for analyzing what's going on, for getting a window into market psychology. But they are not a crystal ball. They give you probabilities. That's it.
And let's wrap up with this fantastic thought from Richard Russell. It's just such a powerful reminder that, at the end of the day, markets are driven by very human emotions, hope and fear. And candlesticks, well, they're probably our most elegant tool for watching that incredible drama unfold, one moment at a time.